Today, we're going to talk about mortgage overlays. Hello and thank you for watching. Today, we're diving into a topic that often confuses most borrowers, bank mortgage overlays. And how do they impact your loan approval and everything else that goes along with it. So if you've ever wondered why one lender says yes and another lender says no, makes no sense, right? This video is for you. Let's jump right on in. First, let's talk about what mortgage overlays are. Every mortgage loan must meet the minimum guidelines set by entities such as Fannie Mae, Freddie Mac, and FHA, VA, etc. These guidelines set rules for things like your credit score, debt to income ratio, down payments, etc. But here's the twist. Lenders can add their own extra rules on top of rules, right? They have their own minimum requirements. These extra rules are called overlays. Think of it as an extra layer of caution that the lenders use to reduce risk. Overlays can vary tremendously from lender to lender, but here's a few common overlays that you'll see often. Credit scores. While FHA allows credit scores as low as 500 with a 10% down payment, a lender might require that you have a 620 credit score to even take a look at you. I actually know of a lender that requires a 640 credit score in order to approve a loan. Basically, FHA says 500, but a bank will say, we're going to make a rule on top of that rule, and they're going to say 640 is their minimum credit score. Debt to income ratio. If the guideline maximum is 50%, a lender might actually cap their debt to income ratio at 43%, right? Again, Fannie Mae, Freddie Mac allow for 50%. Some banks won't allow for you to go above 43% debt to income, or 45% or 48%, etc. Employment history. Some lenders might require 2 years of consistent work history, even if the guidelines allow for less. Property restrictions. Certain lenders may not finance condos, right? They might not like them, or unique properties like tiny homes. Even if they're technically eligible under standard guidelines, that doesn't mean that the bank needs to accept them. Every bank has their own risk tolerance, and they're allowed to set that because they're lending out their money. So the point is, overlays can make it harder to qualify for a mortgage, even if you technically meet the basic rules. So why do lenders do this? Well, overlays is all about risk management. A lender might have had a bad experience with some specific type of borrower in the past, or some specific type of property in the past, so they've tightened up their rules in order to make sure that they protect themselves. It's also important to note that overlays vary between lenders because they have different risk appetites. Some lenders are more conservative while other lenders are more flexible. That's why shopping around is so important. This is specifically why I signed up with 20 different mortgage companies, because I understand that they have different appetites, so I can go to the one that fits you best. So here's how overlays play out in real life. Imagine you apply for an FHA loan with the lender, right? But they deny you because their overlay requires a 620 credit score. You might think, well, I guess that's it. I can't get a loan. But if you apply with another lender who sticks to FHA basic guidelines, you could get approved with a score of as low as 580. So just because one bank says no, that doesn't mean it's actually a no. The key takeaway is this. A denial from one lender doesn't mean you're out of all options. It just means you need to find a lender with fewer overlays or more flexible rules. So here are my top tips for navigating overlays and increasing your chances of loan approval. 1, work with a knowledgeable loan officer who can guide you in the right direction with the right lenders for your right situation. 2, understand your credit and financial profile so that you have a basic idea of what kind of programs you might qualify for. 3, ask questions up front when shopping for a lender. Find out if they have any overlays that could impact your loan. Or I would say go to a mortgage broker such as myself, who have multiple different companies, multiple different mortgage companies, so that we can navigate that for you. And 4, stay flexible. Sometimes adjusting your loan type or property choice can make all the difference in the world for qualifying. In conclusion, overlays can be frustrating, but they don't have to be a deal breaker. With the right knowledge and the right team, you can find a loan that works for you in most cases. If you found this video helpful, please hit the like button at the bottom, hit subscribe for more mortgage tips, advice on real estate, and as always, please remember, life's not meant to be, it's meant to create. Too strong.